So it can completely drain his mana.
Hey, guys.
No time. Just
Hey, Deb, Scott, James, Jeremy. Oh, man. Amar will be joining us shortly. We're going to talk about life insurance. Woo! Everybody's favorite. Life insurance. Life insurance. Everybody. Ooh, someone forgot to tell me to monetize this so I can get that sweet, sweet YouTube money. All right. Everybody now. Life insurance. On the left. Life insurance. Pablo. Life insurance. All right. Hold on a second. Like my officer, stop the spread of socialism. The Officer Tatum store. Big fan. First time, long time. Big fan of Officer Tatum. Brandon Tatum, I think. At the Officer Tatum store. He says, slow the spread of socialism. I'd like to say, stop the spread of socialism. All right, so let's make sure we're monetizing this. All right, where's my man? Make sure I sent Amar the link. All right. All right. Rick, James, Claudia. Hey, where are you coming from, Claudia? Jill? Okay, Paso. No. Where's old Claudia P from? And we've got big night tonight, my friends. Big night. The South Park vaccination special is on. So big plans to watch the South Park. I think is an hour-long vaccination special. So just remember, if you like to laugh, tough to beat South Park, man. So Claudia's from New York. All right. Where's Tara coming from? All right. We got Tara Traeger. All right. We got a lot of ladies tonight from North Carolina, or today. Sharon, right on. Amar brings out the ladies. Everyone wants to see Amar. He brings out the ladies. All right. Actually, Amar got hammered from one of the mains in the house. Right on, Jeremy. Talked to a guy from Erie, Pennsylvania today, and I was chasing out the dogs outside. And I had to take the computer outside, and let's just put it this way: shorts and t-shirt weather today here in Georgia. Tough to beat, man. Tough to beat. Anyway, so as we're waiting on him, let me just check my emails, make sure he. People's Republic of Maryland, right on, Tara. Where in Maryland? I went to high school in Silver Spring. All right, so nothing from old Amar. All right. Breaking news. Michelle Obama is no, I guarantee they're not pushing vax, Jill. There's Amar. All right, cool. So let's jump on here. Can you hear me?
I can hear you. Can you hear me?
Amar, I think you bring out the ladies, man. Got a lot of ladies on board here today. And normally it's just old Josh. They stay far away. So FYI. And just for the record, just what I say. So we had a guy on here that's, saying, Amar, you should not affiliate with Josh and stuff. And just for the record, whatever I say don't put that on Amar, man. My goodness. I mean, he might or may not agree with it. It doesn't matter. Just don't put anything I say on Amar, because that's not, I wouldn't want what Amar says on me. So don't do that. Anyway, just FYI. All right. So we're going to talk life insurance. Now, believe it or not, let me get this thing up here real quick. All right, cool. There we go. Ooh, wait, hold on a sec. All right, there we go. I think people discount life insurance, man. Indiana is supposed to be 70. Okay, so I guess it's warm everywhere. All right, cool. Southern Maryland, south of DC. All right, cool. Right on. All right, anyway, a lot of people discount life insurance. I wish they would not. They'll hear like Dave Ramsey say, I don't even know what Dave Ramsey says, but other people say, life insurance. And I'm just telling you, they're making a big mistake. So we're going to go over life insurance. And tomorrow I'm going to bring up and so if you have questions, ask. Mar, you got a hard stop at 1:30 our time, right? Is that right? Or 2?
Yeah. So we'll try to keep this on schedule. And my office is not working, my Microsoft Office. So if you have the PowerPoint, if you could share it, that would be great.
I do. I thought I did. I downloaded it. Where is it, man? Hold on just a second. So we're gonna. What happened? All right, let me open it up. Life insurance, right there. PowerPoint. All right. Why can I share that? All right. Opening life. I just freaking did this. All right. Hold on just a second. All right. We're gonna go to share.
And maybe while Josh is doing this,
go ahead,
kind of like the disclosure piece of my part is that, everything that Josh and I talk about is strictly for educational purposes. And we just want to give you fair and balanced view of these products. These products are out there because, they serve a specific need. And it's up to you to identify if it fills your needs and so forth. So let's.
I don't know
how to share.
Well, I'm trying to share the. It's not letting me. It says it's lost permission to share my screen. So what I'm gonna do? All right, hold on a second. I'm gonna. Why is it doing that? So I'm gonna hit share. Share screen. Why does it not let me do it? All right. So what
let me share my screen. I was able to open like the web version of it.
Okay. Cool. Yeah. There you go.
Maybe it's not going to be full screen, but at least it'll be.
Yeah, why does it not let me do? Oh yeah. Please do.
All right. So I'm sharing now. Can you see it?
Yep. There you go. Sweet.
So I don't know how to make this like a presentation on. I've never used PowerPoint on the internet.
Do you know they have the internet on computers now?
Wow.
Anyone know where that comes from? All right, so let's go in this deep dive. Hold on a sec. They have the internet on computers from. It's the only way we know he's not a robot. Yeah, right on. All right, so. I've yet to see Amar bleed, though, so I'm not sure he's not a robot. All right, so here we go. All right, cool. There we go. Good stuff. All right, you want to start off or you want me to?
Yeah, well, I mean, again, like you got to ask yourself key questions when you're buying insurance, right? Oh. And the fundamental process of insurance is transferring risk. So you need to identify how much risk can you transfer and how much does it cost to transfer that risk. You may find there's a point where the cost benefit, it may not be worth it. And so only you can kind of decide that for yourself. So making sure they ask good questions and figure out what your needs are and figuring that piece out. And maybe we can just talk real quick. In the insurance business or in the world, there's a basic survivor's needs and then there's a human life value. Think of it like a field goal post, right? So your basic survivor's needs is what does my surviving family need for the next 5 years to keep their head above water, right? And that's basically it, So if you take your income, times it by 5, I mean, subtract taxes and savings and stuff like that. That's probably essentially what the bare minimum you probably should need in insurance. And then if you take the maximum would be human life value. And human life value is that economic impact a person has on a family between today and at the point of normal retirement. So let's just say you're 55 and you're 65, let's just say is normal retirement. So 10 years worth of income. If you take that and get the present value of that, that's how you get the human life. That's how you get human life value. And so you can kind of get a field goal post. So if you're insuring north of human life value, you're probably over insuring. If you're somewhere in between, that's probably the right amount. And if you're less than the basic survivor's needs, then you're probably under insuring. Anything to add to that, Josh?
Yeah.
Questions?
Yeah, well, it's my minimum of life insurance. Oh, sorry, buddy. My minimum is that I think you have enough. My minimum is you have enough to pay off your debt and to leave your surviving spouse, Charlotte, 2 years of income, if that makes sense. So if you got a $300,000 mortgage and you make, I don't know, 350,000 a year, you need $1 million life insurance just for simplicity. So you have 2 years of income plus enough to pay off all debt. I hope that makes sense. So I think that's what you need for a minimum. But everyone's different. So let's go into these the questions to ask yourself, because I do think it's important. So obviously you got what type of life insurance. And I'm telling you, in my opinion, everybody and their mom should have a term policy when they're young. Everybody should, without question. We'll dive into the term. Keep going. There you go.
All right. So life insurance, basically, there's no one size fits all policy, right? So the point of this slide is to say that you may have multiple policies, like in fact, for myself, I have one base amount of permanent insurance. And then when I got married, I bought a term for 30 years. When I had my first daughter, I bought another term for 30 years. And then you just stack these policies. And then eventually, as time goes on, and those policies will fall off, and then I would be left with only a permanent policy at the end. So, fundamentally, when we look at insurance, life insurance, there's basically two types of policies.
Exactly.
There's term insurance and there's permanent. And the big difference is that term insurance equals the cost of insurance. Permanent insurance, your premiums do not equal the cost of insurance, meaning that your premiums can be more or less than the actual cost of insurance. And we'll dive into that here in a bit.
Absolutely.
The one thing when they're figuring out the cost of insurance.
Now, this is huge right here. Just I want everybody who's thinking about term, when they think I have insurance, and as I got it, this right here, this chart that Amar is going to show you, you've got to get that ingrained in your head to say, do you really have insurance? Because keep going, Amar.
Yeah. So let's say you're 40 years old and you're buying a 20-year term policy. So how do they figure out the expense? Well, what these actuaries do is they get a probability of death, and then they equate a cost per thousand for that policy. And so in this, in this example, they get a cost per thousand each year that you're alive, or each year that policy is out there. So let's say you're getting a 20-year policy. So I don't know if I can draw on this, but let's just say 40 to 60, right? 20 years. This is what your cost of insurance is for that each single year, right? So think of an annual renewable term.
Yep.
Meaning that every year you're buying that term for just that next year. And then what they do is they average this out, and then they say, all right, your premium is somewhere here, and this is the average premium for 20 years.
Yep.
Josh?
That's what I'm saying. So what they say is that, hey, this is what's going to cost, but they know full well that you're not likely to die because that's why it's so cheap on the front end. But as you start going up the age, you're more likely to die. That's why it costs so much. So term, I'm telling you, it's not. I mean, it's life insurance. I have term, but like Amar, I also have permanent insurance as well. But term is just to cover you for a term, and that's it. And then it goes away. And that's nothing wrong or wrong. It's not good or it's not bad. It just is. And that's the thing. I think a lot of people say life insurance has this good or bad. It's an inanimate object, and as such. But this is the way it works. The older you get, the more expensive it becomes.
Yeah. So term insurance, you buy it in chunks of time. So
like Amar was saying, he has a laddered term policy. I think this is so. Keep going, Amar. I think it's good stuff.
Yeah. So it covers a fixed period, right? So there are time horizons that you may want to have a 30-year policy. You may want to have a 10-year, 20-year. Obviously, the older you get, some of these insurance companies won't even sell a 30-year policy. Like I think, what was it at USA, Josh? I think it was like at 62. Then the longest term policy you could buy is 10 years.
They basically, once you got in your 70s, USA said you're likely to die, and we don't want to pay it out, so they weren't selling it to you, regardless of the premium. Yep, 100%. And that's why, I think you had said this last time, Amar, but to reiterate, the vast majority of term policies expire because most people don't die while they're covered under. I think it's like 98% or something like that, Amar. The term policies never pay out, which is good. That means you're still alive, but most people's term policies do not pay out.
Yeah. So I think term insurance is probably good, like in your working years when you're accumulating money, because you're replacing income, right? That's a big component of it. So
100%. And I do want to point out, I was talking to a guy today, he rightly so, but I said, what's your life insurance? And he has 2 times the employer amount. Regardless of whether or not that's adequate, and it's not the point of this discussion, but remember, term is underwritten on you specifically. Employer sponsored life insurance, and Amar talked about this last week too, is underwritten on the group, the average of the group. So if you're in good health and you're just relying on your employer sponsored life insurance, you are subsidizing people who are in bad health. So you should probably look at getting your own individual term life insurance based on your own underwriting capability. And the converse of that is, if you're in poor health, getting group life insurance is probably going to be a good deal for you.
Yeah. And especially if it's portable and you don't have to go through underwriting.
Exactly.
I mean, if I've seen people in their 40s to 50s where they may have a health event and then they leave work and they can take a policy at standard tables, like a 20-year term, and they're actually table rated, and they wouldn't be able to get insurance on the private market. So it's
100%. And it's Amar, I'd probably share this with you, but when I was at USAA and I wanted to get my own permanent life or term life insurance, I had them underwrite me, but my triglycerides were high, my BMI was high, and I was going to be rated as a standard, like a smoker essentially. And then which was the group riding. And so I said, whoa, that's expensive. Long story short, I went on a low carb diet, just all that stuff. And a year later, I was rated as, the preferred ultra, and it saved me. A boat. Let's put it this way. I'm lucky I'm still alive, because Charlotte is worth a whole lot more if I'm gone than if I'm here, if that makes sense. So,
and that's a good point, because I know people that will go from grocery store to grocery store to grocery store to save like $5-10, whatever
right.
it is.
Yeah.
When you have insurance, if you can be as healthy as possible right before you're buying insurance,
exactly.
You're going to save yourself thousands of dollars.
100%.
On the policy. And that's more than saving on groceries. So
I could not agree more. 100%. What else they got here? Okay. Yeah, keep going. Yeah, right on.
So term insurance is pretty simple. Is there any questions in the queue about term insurance or anything like that?
Let me hold on. Any questions on term? Just while I'll ask. So just on term insurance real quick too. I like the idea of having laddered. The one thing, if you're under 40, you should get a 30-year term. One of the biggest mistakes I've ever made, Amar, was I had a 30-year term when I was at when I was like 28 or something like that at USAA. And I was like freaking $50 a month or something like that. Anyway, long story short, I dropped it later. And then, fast forward 20 years, I was scrambling to have life insurance when I left USAA, because my group policy coverage was expensive if it was made portable. And I forgot who the company was, but I was like, it was too expensive. And at that point, I had to get underwritten for my own life insurance. And I had a big mortgage. I was driving to Tennessee every day. And I was like, man, if I get killed, my wife is going to be in a world of hurt. So the point is that just get if you're young, I'm telling you, man, just get a long 30-year life insurance term policy. $250,000, $500,000 is so doggone cheap. It'll cover you for many years to come, and never drop that sucker. Because there was about 6-month time I was worried that I was going to get killed on the highway and leave my wife destitute. That was actually kind of scary.
Yeah. The one thing with the insurance is that there's also break points, right? So 250, 500, $1 million.
Is all insurance companies like that, or is that just USAA? I've always wondered that,
Yeah, I think every insurance company has their own breakpoint table, but they're somewhat standardized. I know the 250 and $1 million seems to be standardized. I think the other ones in between could be varying from company to company. But
I think terms pretty simple. So let's go to everyone's favorite topic to hate. Well, here Jeremy says worth getting term life insurance outside of SGL. Yes. All right, real quick, Amar. Jeremy has SGLI, the Soldiers Group Life Insurance, and he asks, is it worth getting term insurance outside of that? One, absolutely, because when you go from SGLI, Jeremy, to VGLI, it's friggin' expensive. Don't do that. Get a permanent life insurance without question. Amar, I mean, that's a slam dunk. It's not even debatable to me. Anything to add to that, Amar, by chance?
Nope. I think that's good. All
right. Well,
so the permanent life insurance, right? So switching gears to permanent life insurance, and we're just talking about the vanilla products. I know products now have riders for long-term care, have riders for income needs. We're not talking about all those benefits. We're just talking about basic permanent insurance. So the vanilla flavor of these three different types of policies. So within permanent policies, you have whole life, universal life, and variable universal life. Those are the three main products. Within whole life, your premiums are guaranteed, right? They're fixed. As long as you make that fixed payment, the policy is guaranteed. Your investments are typically guaranteed because it's based off of a chart that they do once you get your policy. And the death benefit is also guaranteed. And that's key, right? So that, I would say, is the most conservative of all permanent policies.
Yeah, what I'm saying.
Universal life, the difference is that universal life, there's a guaranteed minimum, and then there's what you actually get. So some of these policies can be participating or non-participating policies, but essentially they take a basket of interest rate sensitive investments. And they put it to investments in the market, and if you get more than the minimum, then that's what they flow out to the policyholders. Yeah. Because of that, you could be in a situation where the guaranteed minimum is high. Like I'm thinking about policies that were issued in the 80s where the minimum interest rate is 4%. And in the current environment, you probably be better to overfund that policy, because where else are you earning 4%, right? Guaranteed by an insurance company. The flip side of that is that if you have an insurance policy now, your guaranteed minimum is probably closer to 1%. Yeah. In this low interest rate environment, which means that if they get a good investment, they'll probably pay more than that in the future, right? As rates increase, right? So that's something important to look at. Variable universal life, and this is the most aggressive, because in the most aggressive stance, the death benefit is not guaranteed. I mean, they have funding levels where they guarantee it, but you have to, your funding amounts can vary, your death benefit can vary, and your rate of return on your investments is not guaranteed. It's based off of, like, your 401k. You have these investment options, and you pick from those investment options to see what your rate of return will be based off market performance. The two biggest.
Real quick, let me just add on the. So Amar and I probably get the same when I ask what you have life insurance. They always the default for everybody is I have whole life, and what a lot of times it actually means they have permanent life, but they assume that's whole life, and whole life is under the. It's almost like electricity is part of the energy, all right? So energy is all encompassing. Electricity is just part of it. Permanent insurance, whole life is just part of permanent insurance. It's not exclusively permanent insurance. So when people say I have a policy as whole life, make sure we understand the difference between whole and universal. So on a broad basis, forget universal, a variable universal for the time being. We're just going to say we have two options under permanent life insurance. Both have the ability to build cash value, which may or may not be good. I'm not here to argue or to debate whether it's a good value. I'm not saying that. We're saying at the end of the day, you have permanent life insurance. Under the permanent umbrella comes whole, which is there literally for your whole life, as long as you pay the set premium from when you issued the contract was issued to you. And then universal, which can fluctuate depending on interest, depending on your premium. But if you have permanent life insurance, is critical for you to understand if you have whole life or universal, because two completely different animals there. All right, keep going, Amar.
Yeah. And then I think the two different animals within the policies is that you can have an option A or option one in some policies where the death benefit is constant. And then there's another option, which is called option B or option 2 or whatever you want to call it, where the constant amount is the amount at risk, the insurance amount. So in these two cases, you can see that over time with option A, you're self-insuring yourself, right? So like the policy, let's say you have $100,000 policy and the cash value is $75,000, then you only have $25,000 that you're buying insurance on, right? So even though that $75,000 is your money, the insurance amount is only on that 25. Or you can have a increasing policy where that death benefit increases. So it's, let's just say $100,000 of insurance. It's always $100,000 of insurance. So if your cash value is $75,000, then your death benefit is $175,000, right? And a lot of times when people get these policies, they initially get an option B and then they never change it to option A. Yeah. And it gets really expensive. Remember, going back to this thing, this is the same for term and perm, right? They factor the cost of insurance per 1,000 per year. And, you know, as this gets more expensive, you know, over here, this premium, the cost of insurance goes up.
Cannot agree more, and that's a drawback about life insurance with the agents in particular, is that you'll never hear from one again, and as such, it's on you to figure all this out. And the net amount at risk is hard to see, but the difference between the lines that Amar has on there is how much the insurance company is on the hook for at your death. And it's amazing to me because I know I see what you're doing. Did you want to open that by?
Yeah, I'm going to see if I can. I just had an idea. If I just do a meeting and see if I can use the Zoom tools to draw.
Okay. Wow. On the fly, Amar.
Yeah.
Wow, Amar's on the fly. I just hope there's not pictures of his girlfriend on there because Amar supposedly is married. Notice how we've never seen Amar's wife. Interesting, huh?
All right. Josh, does this come up if I like circle this?
No, did not.
Did not? All right. I'm sorry.
But
good,
do it again. I didn't see that. Do it again. I think it did. I saw it. Yeah, it did. Go, Amar. Perfect. Yep.
Yeah, right there.
Yep.
Oh, cool. So
work.
Yeah. So I think what we could do, if this works, this would be awesome. But let's say if I went like this and I put a whiteboard over here.
Hey, man, this is the high-speed stuff they've come to expect. Look at that.
There we go. All right. So, I think what Josh is saying is that if we come on. All right. So this death benefit, the cash value is going to go up. Yeah. But at some point, this cash value will start to go down because the cost of insurance will become too expensive over here. Right, and this is as age, and then this is the dollar signs here. So once somebody sells you a policy, this is like year one. Nobody else follows up on this policy
ever,
right? And so one of the things that at least I try to tell everybody is make sure that you get a reprojection on your policy every year.
Or at least every other year or so. I mean, but 100%, yeah.
Yeah, I mean, just frequently. Just check in your policy to make sure it's healthy,
Yeah,
100%. I have, you don't want to be 86 having a permanent policy that's going to endow or lapse at age 90. You're going to want to have more You should have known that earlier in life, I guess.
How many times, Amar, in your career, even at USAA, have you dealt with folks whose life insurance is about to blow up because there's not enough cash value in there as they got older? And, you know, and at some point, it's like there's no hope other than dumping just tons of money in there to keep it active. It's and
then it's the children that are dumping in tons of money because they want to make sure that policy's around if there's a life event.
100%.
And so I also think that this is where the negative press comes about permanent insurance policies, that it's super expensive. I mean, it is expensive because you're paying for more than the cost of insurance. But the underlining thing that I think that people, like, if people had better funded policies,
absolutely,
then they wouldn't have as much issue with this. Let me try another thing in terms of sharing. So when
sharing is caring.
So when you have these policies, right, and every year you create a bucket. Let's just call this a bucket.
Nope. Good boy.
So here's the cost of insurance, right? And let's maybe we put that in a different color. Let's put red. So this is the cost of insurance. The insurance company is going to give you different levels to fund at, right? So the first level is the minimum premium. This is the minimum that they'll say that you can have a permanent policy. So most of it, you know, just look at this percentage wise, right? This is like, you know, I don't know, 3/4 going to the cost of insurance and then only 25% going to your investments, right? And then they'll have another dollar amount, which is a no lapse guarantee to age 70. So that means that if you fund at this level, it's guaranteed, your insurance, your death benefit is guaranteed to age 70. And then if you fund it at the next level, and the reason I'm going to this much detail is if you have a permanent policy, you should know these levels.
Yes, 100%. Yeah.
Right? I mean, this is a big piece of this. So and then this is like no lapse to age 100. And then this is max funding. You know, this is the max that you can put in a year. Now, one of the things that's important to know is that you create these every year you own a policy, you have one of these buckets. And so the benefit of getting a reprojection could be like, hey, I've been funding this policy that I bought 20 years ago at this level, right? Just right here, no lapse guaranteed age 70, which, you know, now I have extra money and don't know what to do with it. I probably would want this policy to last to age 100. Well, what you can do is you can fund this to age 100. You can take extra premiums and you can put them in here to fully fund this policy. But you can also go back to previous years and fund more, right? And so you can get more money into this policy to get it to last to age 100 instead.
I did I interviewed, I'm trying to find it, on a guy from your neck of the woods, Amar, actually, and I just can't remember his name, but he talked about life insurance, and it was fantastic. A huge fan. I'm just trying to find the guy's name, and man, it was actually, it's incredible how much insurance agents don't know, frankly, which is kind of frightening. But the ones who do know, I tell you, man, it's amazing, because life insurance is a wonderful tool. It can be used great, but the issue is, it's like, what do we have? All right, so what do you own? What kind of permanent policy do you have, Amar? What's your?
Yeah, I have a universal life policy, and just like you just mentioned, is like most of the people don't know anything about their policies, right? When I first started in the business, my boss told me to buy one, so I bought one. I mean, he's like, that's the way you're going to figure out how the policies works if you own one.
Yeah.
And so that's That's how I got my policy. But
There it is, my man Rajiv Rajiv Rebello. That was his name. So I'll put a link in the show notes later. But all right. So whole life, we talked about that. You're literally buying insurance for your whole life. You're paying a premium, more expensive premium on the front end, because as Amar showed, the older you get, the more the cost of insurance is. So you're saying, I'm just going to flatten it. I'll pay more on the front end versus less, not less, but relatively speaking to the cost of insurance on the back. And as long as you make that premium, you know exactly what you're going to get. It's that simple for sure.
And so we already talked about whole life, and we talked about universal life, and then I put a little chart in here to kind of say, all right, this is what you know from a flexibility standpoint. So death benefit, all of them have a death benefit. The only guaranteed ones are term and whole life when you make the payments, right? They have tax advantages, right? Actually, that should be all in this permanent. This should be, can I delete that? There we go. That looks accurate now. The variable universal life, invest in the markets. Actually, I think that check mark should have been there. Cash value is guaranteed. It's whole life and universal life, right? There'll be a hypothetical, and in the hypothetical, there'll be a column that says guaranteed cash value. And then universal and variable universal life have variable payments. And then if you're looking just purely at cost, term life is going to be the cheapest cost.
All right, and that's all good. But a lot of people are going to say, well, what's the point? I don't want insurance anyway. So let's go over some of the reasons. What else we got on this screen here, Amar? Anything else? Is that
that's good.
All right. I want to go over, Amar and I came up with the top 5 reasons you actually need to own life insurance. And again, I don't sell this, so you're going to have to find a guy. You're a licensed insurance.
Yeah, for full disclosure, we sell life insurance.
Well, how could you, Amar? How dare you sell life insurance? Don't you know it's a scam? So let's go to the top 5. Why can't I get this? I'm trying to get, anyway. You want to start, Amar, with your number 1 reasons to own life insurance?
Well, you have the list.
Okay. So I don't know how to share that. I don't know how to share the list. So I'm just we want to create liquidity for an estate. So life insurance, the benefit of life insurance is at the day of death of the insured. Is it immediate? Well, you got to file a claim with the life insurance company. But once the death certificate is validated and whatnot, you are dead. You're 6 feet down. The life insurance pays out to the beneficiaries immediately, tax-free, by the way. There is no muss, no fuss when it comes to life insurance. Anything you want to add to that, Amar?
Yeah, I mean, when a loved one passes away, it's an emotional time, right? And to be in that situation, to have immediate liquidity, and it bypasses like the courts and all that because it's transfers by operation of contract.
Yes.
If you have a named beneficiary, I think is a big win for the surviving spouse and family to make things easier during this transition. Yeah.
Well, and let's think of the alternatives. You still got bills to pay, and you got to settle with probate. You got to settle with beneficiary designations. You got to do all this stuff as well. And you're like, dude, I got bills to pay. I still got rent. I still got mortgage. I still got this. I still got that. The liquidity of an estate is hugely important. That people who just do the buy term and invest the rest, they always overlook. And it's tax-free. It is tax-free. Now, I will advise you, life insurance is part of the estate for the owner of the insurance policy, not for the beneficiary. It's for the owner. So just be advised. I'm telling you, I cannot tell you how many people think life insurance is tax-free. It's not part of my estate. Yes, it is if you own it. But at the end of the day, it is a hugely beneficial that it creates this immediate liquidity that's tax. I cannot tell you how many clients I've had, because we worked at USAA, Amar and I. We've dealt with KIA, people, surviving spouses with husbands who are KIA. And the issue that the one thing they didn't have to worry about the markets. They had enough money, and more so than SGLI, Jeremy, I'm telling you right now, they had enough money, or certainly VGLI. VGLI is not a good thing unless you can't get insurance elsewhere. But man, they had this immediate liquid estate they could live on to figure out what they're going to do next. If you haven't been in finance, this is one of the drawbacks, Amar, I got with people that kind of make financial planning, blogging as a second career. If they haven't been kind of in the streets working with people, it's easy to look at the Excel spreadsheets and stuff. Once you start working with clients on a regular basis and people who died and people when they're actually figuring things out for the first time on their own, a surviving spouse in particularly, it changes everything, because all that stuff that you read in Market Watch and John Bogle and Bogleheads, that's all good and well, but it really hits home when you're working with a spouse whose husband was KIA or whose husband's been paralyzed in a car crash. It changes everything in terms of being a real financial planner.
So let's go into the second one, and because I think this is going to be really
future insurability was number 2, Amar. Future insurability.
Yeah. So okay, so maybe in my mind I had them missed.
Okay, well, what would you? We can talk.
So the first one was the liquidity, right? And
under liquidity, we had fund trust for special needs or other reason. Yeah. And then we also had increasing the total estate under the immediate liquidity. We can talk about those if you want, but
let's just go in order. So, we live in a world where doctors just prescribe stuff all the time. And, if you're worried and you want to protect future insurability, there's 2 ways to do it. You can buy a term policy that has guaranteed convertibility into a permanent policy, guaranteed convertibility. It's a rider that you would have to get, or you can just buy the permanent policy up front, right? And so having permanent insurance gives you that making sure that you don't have to go through underwriting older when you're older and potentially uninsurable.
I'm going to use this. So uninsurable, just as I use my example all the time, this guy named Rich and I, he's a West Point grad. When he went to Iraq, he was an NBC officer. I forgot what NBC, it's the chemical officer. I forgot what it was. Anyway, long story short, he got some issue with his lungs. He could not get life insurance anymore. He could not get life insurance. He was uninsurable, even though he was separated from service in the military. In USA wouldn't insure him because he was uninsurable. Thankfully, though, he had life insurance from previous, which was convertible. That means what that means is a term policy. We use my man Jeremy here. Jeremy was, I think he's like 28, 29 or something like that. He says, I'm going to get $1 million. I'm just going to throw that out there. You don't need that, but just for simplicity. And I'm going to get $1 million term life. I'm going to get it for 30 years. If Jeremy goes off to Iraq and breathes some chemical agents where he can't get insured, when he comes back, or anytime he wants between now and whenever the time that he's unable to convert it would be, and convert just means he's changing it from his term, his temporary insurance, into a permanent, a whole life or a universal life, and without being underwritten. So he's using his underwriting as a 28-year-old woodsman up in Maine, freaking knocking down trees and whatnot. And then when he gets, freaking not very insurable because he's been smoking and joking cools and drinking beers all day long up in the Maine winters, they're going to say, yes, Jeremy, you want a new insurance policy? Yeah, because I'm going to die next week. He goes, okay, well, this policy is about to expire. He says, no, I want to take a portion of that and move it to a permanent policy. It doesn't have to be the whole $1 million. It could be a portion thereof. And I want to move it to a permanent policy, but I do not need to go through underwriting again. I do not need to get a blood test, BMI, all that stuff. I'm telling you right now, my friends, this is such a critical, important thing to have that I cannot, Amar, it drives you crazy how many people just hear the term whole life and they think it's bad, and as such, they don't take the precautions to protect themselves from future insurability. It annoys me. All right, here's a link for the other video. All right.
You want to do the next one?
Yeah. So the next one here is this is a great one. Leveraging tax-free premiums. Tax-free premiums. So you're using tax-free money to pay your premiums when you're in a high tax bracket. Take it away, Amar.
Yeah. So, when we think about paying premiums for the insurance policy, we have to earn that income first to pay the premiums. And so you pay taxes on your income, and then with your after-tax dollars, you're paying for the insurance policy. Well, within a permanent policy, if you upfront fund it with a lot more money, then later in life, while your income may be significantly higher, you're going to have to earn a lot more money to pay those premiums. Or you can just stop paying and have the money inside get eaten up by the policy, meaning that your cash value, what it's earning, can go towards paying the premiums. And that is a way where those dollars are never taxed, once it's in the policy, and therefore that's tax-free, in the sense that and I'm going to give an example. Let's pretend you're a doctor in residency and you have family that can afford, or you get gifts or irrevocable income trust or something that you're not financially stressed. Well, if you bought a permanent policy, you could fund that. And when you're a resident, you're making close to $75,000 to $90,000 per year. And then as you fast forward and become a doctor and you're making the big bucks, you're in a higher tax bracket, And I've seen residents go from the lowest tax bracket to the highest tax bracket. And that's some serious savings in terms of the insurance side of the equation.
And remember what I always say about imputed income, where people say your house is a liability, not an asset. That just is stupid. If you have a house that's paid for, what do you not have to pay? Inherently, you don't have to pay rent or a mortgage. Now, you still have to pay property taxes. I get that. But because you do not have to pay rent or a mortgage, that means you don't have to earn that money in which to pay rent and a mortgage, which means you don't pay taxes on the money you did not have to earn in order to pay the rent or the mortgage. It's called imputed income. It's the amount of money you need in order to live in the house that you currently have. So the whole idea that the rent, owning a home is stupid. Same thing happens here with life insurance. Once you have enough cash value built up in there, the policy essentially endows. It means it pays out itself. It pays for its own premiums, essentially. And so when it pays for its own premiums, you get a 1099. No, you do not. No 1099. So the income that you're making on said policy is being used to build back either more insurance potentially or to pay the premiums. So it's tax-free premiums, which means the money that you would normally have used for the premiums can go to other things, like giving money to your old buddy Josh. I think that was overlooked a lot, Amar. I think just real quick, I had an example. You going back to school? We got. Did I tell you, Amar, that that kid right there, Liam, his friend had COVID, and so they had to be quarantined for 14 days. So I called Liam the COVID kid. So I got.
Let's get through these top five, and then we
go. You're saying I'm falling off my. Yeah, you're saying like my mind is watering.
Well, Michael's got a good question here, and basically, I want to make sure that we address it. That the financial stability of these insurance companies. I mean, I think it's important, right? Yeah. You're going to want this policy to be there when there's a life event, and so you want to make sure that the insurance company is stable. I think one of the things that happens is that these insurance companies, in order to attract more business to spread the pool, the risk pool, they reduce their rates or whatever it may be for a time period or for a product, and they try to get more money in. And you have to ask yourself that if a AAA rated company, which I don't even think there's AAA anymore, let's say AA company, and somebody that's single A, and you see the rate difference, well, there is a difference because the AA is financially stronger.
Well, if you look at Penn Treaty, I was trying to go back to this guy. So Penn Treaty, they issued tons of long-term care insurance contracts back in the 90s, and they went kaput, as did we talked about this last week with Genworth. The issue is when that happens, you don't want to be holding the wet bag. So you got to make sure you get a financially sound insurance company. And like New York Life, strong, Mass Mutual, strong, USA, strong. You got to make, and you're going to probably pay more for those. Well, the reason you're paying more is because you're paying more for conservatism to make sure that money is there upon your death.
Yeah. And so when they take your premiums, they're reinvesting that, right? And trying to make a return. It also means they're investments that they're making are less aggressive, right? Because they're taking in more premiums, so they don't have to get the same rate of return. So I think that's important to put in.
You are hearing a bird, Jeremy. We got some nice spring weather out there. All right. I want to talk about tax efficient or we're going to skip over one, non-market correlated asset. This is huge.
Yeah, so I mean, I think it's really important to say that the markets are volatile. I mean, like I think we've all seen it recently in the last year. But I mean, I've had clients that go through life events. And one was like almost, I think, December of 08 or November of 08, right before the bottom of the market, and everything was in real estate. Everything was illiquid. Everything was in the stock market, invested aggressively, right? So the more aggressive you are, the more complex investments you have, you're probably going to want to have something that's not market correlated, that provides immediate liquidity. That's just the fact of it.
Let's use this a little bit more detail. All right, so old Josh dies. He had $1 million in the S&P 500 on October 2007. I die in January 2009. By the time the estate settles, my $1 million in the S&P 500 is worth $460,000. All right, not good. I had $1 million death benefit in life insurance. What does my wife get? She gets $1 million. It's literally that simple. There's no if, and, or buts. That's just on the death benefit. Now, there is something called cash value. Now, this is what changed me against the Dave Ramsey's of the world when it came to whole life insurance. This was whole life. I had a guy who had taken out, he paid $100. He had basically as a key man insurance policy. I can't remember what type. In the 80s, he'd taken out a policy. He had put $100,000 in there for like 5 or 6 years, something like that. All right, he had with the USAA. That puppy was worth, I think, a death benefit of like $5.5 million by the time I started to talk to him in 2010. His cash value was worth $3.5 million. He was getting, I think it was 5.8% minimum guaranteed each and every year. 5.85% minimum guaranteed, no 1099, completely tax-free. It was freaking insane. And he's always, and so many people try to get him to sell that life insurance to go with investments. He's like, why in hell would I ever do that? I said, no, it'd be stupid to. And the minute I told him he'd be stupid to sell, he goes, Josh, you're my guy because you're telling me like it is. All these other guys saying, you should go manage money. It's like, that'd be freaking dumb, man. Because 5.85, the tax equivalent yield on that was like 13% given his tax bracket. Had nothing to do with the markets. Markets going up and down, he didn't care. He's sitting back getting 5.85. And I said, wait a second. And he never had to pay a premium again because he has so much cash value in there. So going back to what Amar was saying about tax-free premiums. Yeah. It was, I said, wait, so I've been lied to about life insurance. Now, what happens here, my friends, if you're going to do a permanent life insurance, this is where freaking people drop the ball. You got to fund that puppy. You've got to have the cash on the front end. If you're underfunding permanent life insurance, like this guy did when I first bought a policy, which meant my premium was supposed to be $500 a month, but I was only paying $200 a month because I couldn't afford $500 a month. Now I could get by with that, but every month I'm underfunding it is more and more I got to come up with later on down the road. And as such, that policy was going to expire. And finally I recognized that this is not going to work for me. So I stopped. But I'm telling you, if you can fund a policy with lots of cash value on the front end, especially while you're young and the cost of insurance is cheap, it's going to be tough to beat a life insurance policy as a non-correlated asset. Doesn't mean it's going to be tough to beat it as an investment because life insurance is not an investment. It's insurance. But
that is key. It's not an investment. It is insurance.
And people say, well, I had a guy the other on my first star's YouTube channel, I'll never forget, rookie broker. I'll never forget. I said, dude, you're new to the business. I can tell. He goes, I'm with Mass Mutual. We pay 6.5% each year. I said, okay, run me an in-force illustration. I put $100,000 in there. What is my cash value after year 10? And he said, $89,000. I said, yeah. What's my cash value after year 20? $114,000. I said, that's what I'm talking about. You're not paying 6.5 each year. That's your crediting rate, fool. It's your crediting rate. That's not my net rate of return. And if you're going around saying you're selling it as a 6.5% interest rate, you're lying to people. And the error of ignorance is no exception here. And it friggin' infuriated me. And this is what happens on life insurance. People can type anything they want. There's no regulation on that except the states, and they don't care. So it's just like, you got to be careful. When people say you're getting 6.5 or 4.5, no. That's a crediting rate. That's not a net rate.
Yeah.
All right, so I also want to talk about just creating an estate real quick. And this is kind of a corollary to just creating liquidity. Life insurance is the only asset that will create an immediate estate. All right, so say your old buddy Josh, I say, look, man, I don't have a pot to pee in, but I'm in pretty good health. And if I die, I'd like to leave some money to the church. I'd like to leave some money to Amar. I'd like to leave some money to the dogs. How else can I do that? I can only do it with life insurance. There's no other way, man. You can, for right now. So the only way is through life insurance. I can create an immediate estate by buying a life insurance policy. So if I die, I know for a fact there's going to be money to go into the charities and the people I want to receive it. Now, with that said, talk about the your tax efficient. We talk about tax efficient transfer of wealth. Jump on that, Amar.
Yeah, I think the big piece here is that if you have a larger estate, you can use it to get out of your estate, in terms of you can use the life insurance to be outside your estate and to create some leverage by gifting money to the policy that's outside your estate. And that's what creates the tax efficiency, right? So if you have assets that are subject to the estate tax, this is a way that you can take assets outside of that piece. And so this is with the crummy letters, right, Josh?
I don't even think we need to go that far right now. There's another way to do it, like you were talking about before, with IRAs and life insurance. Go into that.
Oh yeah. Okay. So sorry, I thought you were talking about something else here. So like, because of the Secure Act, right? The Secure Act, your children have 10 years to distribute your IRA assets.
Exactly.
What if you have somebody as a child that is gonna like either spend it all really quick, or you want to put some more control over those funds? Or what if you have a special needs child, right? So one of the things that we've talked about with clients is having their IRAs go to charities as a beneficiary, but also having a life insurance policy for their children, or on them for the benefit of their children, in a trust where the trust has terms for the distribution of assets. So you could theoretically get the same death benefit as the IRA that you have, and then have that asset transfer to your children into a trust that would have distributions for, in perpetuity. Or, you can have 30, 35, 40, different ages. Or you can have it bounded by the special needs agreements, so they don't get kicked off of Social Security or any of those other benefits.
But you can even make it simpler than that. So let's just say I have 4 kids and I want to have $1 million net worth. That's my goal, $1 million. And I want my kids and my church to split $500,000 each, if that makes sense. What I do is I leave $500,000 of life insurance to my children because it's completely tax-free to them, and there's no distribution requirements in terms of 10 years. Now, if one of my kids is snorting coke, I'm going to put it into a trust so he doesn't snort coke with it. But so what I want to do is I leave my IRA to the charity because the IRA receives it tax-free, and I leave my life insurance to my children because my children receive it tax-free. I cannot tell you, and we'll do more on estate planning on this, but I cannot tell you how many people screw this up. I'm leaving $100,000 to freaking the SPCA, and I'm leaving that as part of my cash account. And I'm going to leave $100,000 to my kids. That's the freaking biggest mistake you can make on estate planning. You should not do that. In this case, we're going to use life insurance to allow you to leave IRA assets, which have yet to be taxed, to charities, and not rob your own children or your old buddy Josh of the money you want to leave. We're going to leave him life insurance because it's tax-free. It's a simple, you just got to think about this in your mentality. I have this money. Who gets it net? Life insurance is net. IRAs are gross. Life insurance is net. IRAs are gross. Life insurance to kids, IRA is to charity, and that's such a wonderful, wonderful way to create an estate that can benefit your charity and to take advantage of your kids too. All right, so we got some questions here. We could go on this forever. So we talked about financial stability. Let's see, Jeremy, I have 6 years still to go to the military. Is SGLI not enough while I'm still in, or is term life needed before I get out? Mar, you want to tackle that? Because I know you.
I mean, I think that's situation dependent.
No, this is independent. You go inquire about getting a permanent, a life insurance policy, private policy, Jeremy. We're not relying on VGI. You need to inquire about getting a life insurance policy outside of SGLI. I'm just telling you right now. Amar's right. Everything is dependent on your situation, but in this case, you need to go. You say, hey, USA, I need a $250,000 life insurance policy, and just let them run you through that. But no, there's no reason not. It doesn't cost you anything, for heaven's sake. I don't know. Do you even do term, Amar, or what? Mm-hmm. Yeah. So Amar could probably. I mean, I'm not. Look, you do whatever you want, but 28-year-old guy, a $250,000 term, it's like $15, $20 a month, as long as you're not smoking and joking. Easy, man. No reason not to do that. Right here, good question, good point. Capture of state regulators by insurance companies can definitely be a problem. Yeah. The old capture. It's almost like the pharmaceutical industry has captured CDC. Who gets more money from vaccines than anyone in the world? Anyone want to take a guess? I'll let you think about that. If they get a fat commission, they'll say anything. Well, they shouldn't. But anyone will say anything for money, but not everybody will, if that makes sense. All right.
I would just say one thing to that is that there are life insurance and annuity products that don't have a commission associated with it, and they're fee-based life and annuity products. So, if you're worried about commissions, then you should check those type of products out. Still get life insurance, still get annuities, but there's no commission associated.
Talit Zawade, I think she's from Detroit, if memory serves. Maybe I can't remember how the granted rate worked in like 4%. All right, so Mar, you want to? So basically, the crediting rate is what I was talking about. She's asking, well, how does it work? You want to talk about that by chance, or? No,
go ahead. And I got 2 minutes here, so I think there's a couple questions that maybe I can answer real quick.
Okay, good. We'll come back to that, Talit, because that's an important one, which I'm pretty familiar with. You want to tackle this one right here, and IUL?
Yeah, so one of the things that I would say is a life insurance policy, it's very expensive to recreate income from a life insurance policy. Remember, there's a mortality and expense fee. There's the administration fee. There's also the investment fees that they may have. This looks like an index product, so there may not be as much on the disclosed fees on the index, but they have fees built into that. From crediting to caps and stuff like that. So for monthly income, you probably want to get a product that's geared towards monthly income. So
I'm not a fan at all, especially when I saw the word Allianz, I should say. When I was a broker, Mar, you got to, anything, we'll let you go. Stay on. I'm going to stay on for about 30 more minutes, guys, but there's a lot more on life insurance I want to chat about because this is important to me. Amar, I know you got to go. You got to work with clients and make that sweet, sweet money. Anything final questions, thoughts, concerns that you want to add here?
No, I would just say if you're getting value from this series that Josh and I are doing, please subscribe at least to my channel as well. You're already probably subscribed to Josh's, but mine's at Client First.
You got 4 people on your channel right now watching tomorrow. That's cool. That's good. Wow. So we got 4 client first cap learning. Client first cap learning.
And the second thing is that if you have ideas or if you have more detailed questions that you want Josh and I to kind of drill down and it's in alignment with what we're talking about, we're happy to do so.
Could not agree more. I just want to see what your so let's see what Amar's subscriber base is here. 274. So Amar needs more so he can get that sweet, sweet YouTube money. So do me a favor and subscribe to Amar's channel if you haven't yet. We need to get him above 1,000. Please do. And Amar's, I don't care what they say about him. Amar's a good guy. All
right. Thank you.
All right. Thanks, Mar. We'll see you.
Bye, Josh.
Thanks, brother. I'll call you later. All right. So I want to talk about what Talat Talat said here, where was it? I failed the internets. Yep, I do, man. Ooh, they got the internet on computers now. That's Homer, by the way, right here. All right, so let me tell you what happens here. And this freaking is a pet peeve of mine. What they do to lads, they say, hey, you're getting 4%. All right, yeah, you might be getting 4%, but they're taking 3.5% in fees. This is what drives me freaking up the wall. I'm like, if I were to say that if Amar were to say that you're getting 10% a year and not disclose that he's charging 2%, he doesn't. I'm just using that for example. That he would lose his license. And I don't know if Jill's still on here, but she sends me on occasion, some Facebook chats that she does with some life insurance guys. I'm like, I can't believe these guys are saying this. It's I'm not gonna say it's illegal, but it's ridiculous. Like, you can't say that stuff. And this is the drawback about. There's a guy on YouTube that every now and again people email me, hey, what do you think about this guy? I'm not gonna say his name, but I'm like, if I were to say half the things that these guys said when they're life insurance agents, I would be friggin' sent out I would be sent to a vaccine quarantine room for the rest of my life, because you can't say this stuff. It's nuts. And it insinuate that I'm giving you 4% as a net to lad, and not turn around and talk about, oh, but it's costing you 3.5% is freaking, it's insanity, run muck. And they do that all the time. I'll never forget this guy. And I said, so I'm telling you, I said, okay, so I'm putting it was called a drop in. I'm dropping in $100,000 into your stupid life insurance policy. You're saying I'm getting 6.25 or whatever the hell it was. I said, so what will I get? What will my cash value be after 10 years? 87,000. And why is it only 87,000? Because he's paying a big fat commission. There's lots of fees. I said, well, okay, well, that's not 6%. Well, that's the crediting rate. I said, okay, well, you're implying, in fact, you said explicitly, we pay 6%, 6.5%, something like that with Mass Mutual. And I said, it's bull cocky. So I said, okay. And he goes, well, yeah, but the first, we got to get the fees back to underwrite it to pay the commission. It's okay. Well, that's not 6% for the first 10, but I'll grant you that. What is the cash value after year 20? 114,000. I said, so I've had the policy now for 20 years. I dumped in $100,000 that is no longer over here in a VTI, and 20 years from now, I got 114,000 to show for it. That's not 6.5%. That's not 6%. And I can take my trusty calculator if I want to, but I don't. I said that's a rate of return net that is freaking not. And he was just an ignorant boob. He did not know what he was doing because he was new in the business. And that scares me about anyone who's new in the business, not just in insurance, but in financial planning as well. I see this all the time. I just, I can't tell you, well, you should invest in this company or that company because look at what's done over the last 3 years. Or this mutual fund. My portfolio did better than his because 3 years ago, you had 100,000, I got 175. And now his portfolio only got 150. That's freaking, it's mind-bogglingly, it kills me, man. And that's the sad thing is when you've been experienced enough, you get some, you get some, what's the word I'm looking for? You just see a bunch of crap and it friggin' pisses you off. And you got to go out there and you got to beat the drum and scream bloody murder and say, wake up, people, wake up. This isn't how it is. And again, going back to, people who are pretty active in financial planning who never really been in the business. I think a lot of them are doing great. But my concern is how many have actually held a client's hand with a husband dying, a husband with Alzheimer's during a market crash while the husband's dying. And that's a whole different thing in financial planning, which is why I beat the drum when I talk to clients all the time. I said, all right, you got $2 million. Husband's got it all in his name because he worked for Google. And Mrs. Smith, you got nothing in your name. Or what happens if he has a stroke? Oh, I'm the beneficiary. I don't give a crap. I didn't say he died. He has a stroke. What happens? Well, I want to talk about my stocks. That's what the husband will say. I want to talk about stocks. I don't want to talk about that. I don't care two craps about your stupid stocks if your wife is laying out there to dry. I don't. Or vice versa. I don't care what it is. Your wife is stuck out to dry because you have no beneficiary. You have no durable power of attorney. You got no living will set up, and a living will is just right to die clause. You got no healthcare directive, and you want to talk about should I invest in Fidelity Blue Chip or T. Rowe Price Blue Chip? I could care two rats' butts about that. It matters. It's flipping coin toss, man. Oh, it infuriates me so much. All right. So anyway, talent, they're giving you 4%, but they're taking 3.5. Sometimes they're giving you 4%, they're taking 4 to 4.5 because they got to pay the commission to the broker. And usually it takes about 10 years for they get back to whole. With that said, I like permanent life insurance. I am a fan of permanent life insurance. I have not 1, not 2, but 8 policies. 2 on each of my 4 freaking rugrats there. Because I know at the end of the day, when you buy a permanent life insurance on a younger person and the cost of insurance is so low, that means more and more of that cash value is being used for you to draw the interest rate that grows tax-free. And the more you can fund the policy while the cost of insurance is cheap, the more that sucker is going to grow in cash value. No, it's not an investment. It's not a stock replacement. It's not. And I don't even want to say it's a bond replacement. It's not. It has nothing to do with the market. It's a non-correlated asset. You don't look at it like the term versus buy term and invest the rest. You're looking at it wrong. You look at it like, if this were to happen in my house, if this were to happen in my real estate, what do I have here? You got to look at it correctly. And by the way, there's no 72 T's. There's no 59 unless it's a mech, and you shouldn't, generally speaking, we're not talking mechs. I don't even want to get in that. The life insurance is there for the taking if you need it, as long as it's not a mech, all right? And I don't want to talk about that, what that is. But why would you not consider it? It doesn't make sense. Well, because Dave Ramsey says it's a scam. Well, Dave Ramsey's a fool when it comes to this. Dave Ramsey's a fool when it comes to reverse mortgages. He doesn't know what he's talking about. It friggin' ticks me off. How many people are missing out on good opportunities for whole life policies? So I have 4 in each of my kids. They're 20-year paid up, which means after they paid for them for 20 years, they essentially endow. A lot of people, but that's simply, and this, what I use endow for is that the funds are paid up, which means they never have to pay another premium. There's enough cash value in there to pay the premium. And so what happens is they can never, ever, ever get denied life insurance on those policies because it's paid up. There's no more premium to pay. Now, if I want to keep paying it, in theory, I could. If I want to pay more, I don't know if that would work because then it would be mech. But still, there's a lot of benefits there. And because I took them out when the kids were so cheap, it's freaking nothing, man. And if they can't get insured in the future, they have that level of insurance right there. And if they want to use it to a down payment on a home, they have it right there too. Lots of benefits there. I don't like index and universal life. I don't care what anybody says. If you're not using dividends as part of the because they're using IULs as an investment comparison. I just find that stupid. If you're not using dividends and you have participation rates and all this, I don't like that at all. It's not part of a retirement portfolio. Now, I will say, and this is one thing I wish these guys would sharpen up. The nice thing about these universal life insurance index policies, fixed, what do they call it? I forgot. But remember, the dividends are not part of the program. And I've done 1,000 million stories of Sunday that show the value of reinvesting dividends is huge. The nice thing that they do, and I grant you this, is that when the biggest risk to your portfolio is a market decline, it's awful hard to recover from market crashes. And these portfolios will eliminate market crashes for you. That's fact. And Allianz, I don't have a good taste in my mouth. I remember I went to a thing 20 years ago, and Allianz was saying, we pay 10% commission. So it was all these sales agents. 2002, 2003, hell, maybe, I can't remember, a long time ago. And their biggest pitch was our commissions were the highest. I'll never forget that. I said, man, if that's it just rubbed me wrong. I said, if that's your sale pitch, that Allianz has the highest commissions, it infuriated me. And look, I got to get paid. I get it. People got to get paid. I got no qualm with that. But if your sales pitch to agents is that you pay the highest commissions, that's I find that to be not to be good. Yeah, right here. Q says I can't get life insurance because of pre-existing conditions. I'm telling you, man. I cannot tell you how many clients I've had. Hey, my wife just got diagnosed with some kind of cancer. She had a term policy. Is there any way we could convert that to a permanent policy? Yeah, sorry, man. It's gone beyond its time to do that. My husband, he's getting sick now. We just got diagnosed. We still have all this debt. The real estate values are falling across the board. What can we do? Nothing, because you didn't take precautions on the front end. So I got $1 million life insurance policy. It's convertible up until is it 3 years before it expires? I can't remember. But it's convertible. So let's just say I took it out when I was 45. I think it's a 25 years, so I have it till I'm 80. So let's just say it's convertible up until 3 years before expiration date. I off the top of my head, I can't remember exact. So it cost me $1,500 a year for $1 million term life policy because I was in good shape when I got it. Because I got my triglycerides low. I got my HDLs high. Remember, LDL is silly, but HDL is a good cholesterol. You want that high. LDLs, everyone's like, you want LDL? No, but triglycerides you want low. That's a fact. I got my BMI low because I went on heavy low carb thing, and I got underwritten as a preferred ultra, which is good. Anyway, so what happened was I have $1 million term life policy. I pay $1,500. It's actually maybe $1,400 a year, maybe 20 years. I think it's 25. I think it's till I'm 70. Anyway, yeah, I think it is till I'm 70. So when I'm 67, I have to figure out if I want to convert that to a permanent policy. So between now as a 50-year-old old man, I got 17 years, I think, to decide if I want to convert it later on down the road. I'm not converting it now. I'm not, because I don't think I'll need it. But if I'm 65 years old, man, and I got freaking some serious issues physically, and I'm not going to survive beyond 73, the hell's bells, I'm going to convert a portion of that to a permanent policy to make sure it's there for when I die. Damn right, man. You don't want to wait now until I'm 68 and then I get a terminal illness. I say, hey, I forgot who I got my insurance company with. Hey, Son America, it's all your old buddy Josh. I'm 68 years old now and I got terminal life issue. Can I convert my policy? I said, nah, you should have done it last year. The problem is your life insurance agent will never call you on that because there's no incentive for them to. There is none. I'm just telling you right now. All right. It's right. CDC. That ding, ding, ding. Y'all ever watch or listen to the podcast? I love it. This guy, Adam Curry, you know who that is? He used to be on MTV or something like that. It's called No Agenda Podcast. I love that guy's podcast. Huge fan of Adam Curry. He was on like Joe Rogan or something like that. And, man, he was spitting truth balls like you. I said, this guy, Adam Curry, said that sound. I'd never gone to MTV, so I could care less. But I was like, that guy, man, truth balls like crazy. And so if you're listening to podcasts, No Agenda Podcast by Adam Curry, and I forgot the other guy's name, Dvorak. It's fantastic. Big fan. First time, long time. Bill says, great stream info. You got it, man. Hey, Ahmad Ali is from the UK. Right on, man. How to add. Not sure, dude. Not sure what he's asking. You got it, Claudia. Amar's stream is better than Josh's. Yep. Yes, I'm subscribed to Amar. Good. Amar says his worst favorite band is Pink Floyd because he's smart. And I'm not sure what that's in reference to. All right. Yeah. So here's Jill. Yeah, I'm here. It's nuts how they do that on Facebook retirement groups, subtly selling life insurance and annuities using the premise of working until 70 and not relying on the stock market for 401k. So there's another guy on YouTube that's doing bad Roth conversions. I'm not going to say who he is. You'll have to figure out yourself. I must have 1,000 people reach out to me about this guy. Bad stuff. I'm just telling you, man, if it's too good to be true, it's too good to be true. And a number of y'all had reached out to him to inquire what he was doing about his Roth conversions. And like, you can do whatever the hell you want. It's your money. I'm a libertarian, man. You want to freaking send it to me? You want to light it on fire? Do whatever you want. I don't care. But if it's too good to be true, it's too good to be true. And I'm just telling you. So anyway, we have life insurance people all over YouTube because they're not regulated by FINRA or the SEC. We got other people talking tax stuff that are leading you down a path of scary stuff. Let's think about it like this. Look, man, I'm not the brightest bulb. I get it. You know what I'm saying? I've been in the business a long time. I'm a cynic, and I'm also by nature. I get it. I'm contrarian by nature. Some people don't like that about me. Okay, whatever. But if there's a way to get the freaking IRS off your back, I'm going to know about it. And if the way is that you can take $1 million, convert it to Roth, and get $400,000 or $500,000 of tax credits and deductions, I want to know about it because I've never heard that, and because I haven't heard that, either I'm ignorant. Again, ignorant just means you don't know. Doesn't mean you're stupid. Just means you don't know, or there's something that's come down the pike that that sounds awful fishy. So I'll let you put two and two together there. My man Medic says he's an account with Schwab. Vice President cold called me, want to talk about wealth management insurance projects. Yeah, well, I see that. Okay, I want to talk about this real quick. I don't have any problem with that, actually. Vanguard will never do that. That's the one drawback about Vanguard, or the one benefit is. This is my problem. It's not even a problem. People ask me, how about Fidelity, Schwab, or Vanguard? So I worked at Schwab. I worked at Vanguard. I'm very familiar with Fidelity. I got people who work all three, friends. Schwab's my favorite because Vanguard will never call you. If you call Vanguard, hopefully you'll talk to somebody who knows what the hell they're doing, because they just don't pay that much because they're such a cheap organization. And it's well run, but they're just, I trust me. I work there. I know what it's like. They don't pay you that much. Fidelity is more sales. That's all there is to it. And my concern about Fidelity is you're going to get some guy calls you out of the blue and says, hey, we got this SMA, especially managed account that Kathy Woods runs. And hey, money. You're like, I don't have any problem if someone wants to talk about your overall wealth management experience. I got no qualm with that at all, because you can tell them go pound sand. You can say, well, what are you talking about? I got no qualm with that. The issue is when it comes to like a life insurance policy is, are they calling you back after the policy has been issued? And that's the question is no, because there's no commissions to be had. I issue you a policy at $1 million. I get paid 65% of the first year premiums. First year premiums are 60, or we'll say $100,000 for simplicity. Me as the broker gets 65% of that on the front end. That's on the typical front end commission of the life insurance policy. All right. Now, Amar, I'm going to sneeze. Oh, excuse me. Finney just jumped. Excuse me. That was kind of rude on old Finney. I didn't sneeze on him. Oh, poor boy. He's like, dude, what the hell? So the life insurance agents that are commissioned get, I tell you, when I used to work in Portsmouth, New Hampshire, there's a life insurance agent that we used to compete with who had this huge house right on the water, huge. And I always said to myself, and I try not to mean other people. People got to make a living. I always say, why are you living in this, 3-bed, 2-bath house while that guy's living in that? I don't care, but do you not find it interesting that the guy who's selling these products are living large as possible and you're friggin' living like this? Is that odd to you? It's odd to me. As such, I just kind of, this house, it was a beautiful house on a beautiful area in New Hampshire overlooking the water. And I said, man, it was nice. I'd never been there. I'm sure he's a nice guy. A lot of life insurance agents are nice guys. That's how they get the sales. But I wondered how many times he followed up with in-force illustrations with his clients. And the answer was not very many. How do I know that? Because I talked to the clients. I said, hey, when's the last time Joe Insurance Agent called you about this? No, it hasn't. Yeah, it's been 10 years. What's cash value doing? Has it gone up? No. It's gone down? Yes. But my statement says I look good. Do you? Do you look good? Let's dive into this and get an in-force illustration and see how this puppy works. Yeah, if you don't freaking put more money in or die, that policy is going to expire before you do. But yet that guy's still living in that house. Interesting, huh? Freaking my industry it really needs to take some Vanguard freaking medicine. But with that said, Vanguard won't call you. That's the drawback. So anyway, yeah. So I'm telling you. Let me. All right. So here's my man Najib. What the hell's his name? I put it on the show notes here. Here, hold on just a sec. I love this guy, Rajiv Rebello. He's out of San Diego, man. I know I put it on here. Hold on just a second. You guys are making fun of me as if we're friends. No one's my friend here. Oh, right here. All right, so let's go to, if I can, oh, man. No way. I guess I can't. All right, never mind. You can't, I don't know. Can't click that? Ooh. Let me see something here. 1 sec. Ooh, no, shoot. Anyway, Rajiv. I tell you what. Hold on a second. Let me go. Rajiv. Oops. I hope you can tell. I told Amar, I said, when we're done, I'm getting off the live stream. I enjoy live stream. It's the only time anyone will actually listen to me when I'm talking. All right, so we're gonna go to Rajiv Rebello, where his right here. All right, cool. So Jeremy, we're going to go to right here. Rajiv, right here. Okay, cool. And I'm going to share that screen with you. Right here. Now I got, I talked to someone the other day who said he had a big stroke. No, was getting ready to have a big stroke because his ears were clogged up. And then literally the next day, this ear started getting clogged up. My wife says allergies. Allergies are going like crazy around here. But I was like, man, I hope I'm not get ready to stroke. That's for sure. So anyway, all right. So let's go to his website here. This is colvaservices.com. I'll put that link in the show notes here. colvaservices.com. I'm telling you, I learned a lot from this guy about life insurance. And trust me, I'm not some rookie, I tell you, but I learned a lot about this guy. And go to his blog. He had written an article for let's see, subscribe. Let's see. All right, just as an FYI, folks, if you always want to get a pretty girl as an image, I'm telling you on YouTube, if you're doing a YouTube channel and you want to get clicks, just get a pretty girl on there because that, I'm telling you, we know for a fact that draws clicks. It does. I don't know what chicks like. I don't know. Maybe a man, but more dudes are on YouTube than ladies. So just as an FYI, if you're doing a YouTube channel, you got to make sure you get your thumbnails up. Oh yeah, right here, dude. Just all kinds of great stuff. Fixing just. This is fantastic. 4 financial advising strategies for high earning professionals to increase after-tax wealth. So Jeremy, that would exclude you because you're in Maine. You're not high earning. Why fee-only fiduciary financial advisors should be considering no commission fixed index annuities. Lots of good stuff. Big fan, first time, long time. So anyway, just keep that guy in mind. colvaservices.com. Pretty girl, I tell you, pretty girls draw men in. Look, it's a fact, and I'm sorry if that's offensive to anybody, but I mean, we shouldn't, but well, we do. That's it's nuts. So if you're trying to do a YouTube channel and you want clicks, again, I don't know what my wife draws. Trust me, what draws my wife's eye isn't dudes. I'm just telling you right now. How do I know? Because she has to look at this guy. She has to look at this guy. She goes, oh, okay, I forgot I'm married to you. I was like, oh, man, I've been working out, babe. Look at me. I'm working out. She goes, whatever. I'm just joking. But you got to get your thumbnails up. My thumbnails suck. I'm not going to lie. I'm too lazy. All right, so we got Talat says, I have 51,000 subscribers, and you still remember me from Detroit. Oh, well, thanks, Talat. Right on. Well, you got a unique name, Talat, and I appreciate that. But, yeah, right on. Of course, of course. Who's this guy, Jeremy? I think he's from California. All right, so I guess that's it here today. Yeah, James says he cannot get life insurance either because he's Greek. James Palas is certainly a Greek name, and who wants to insure people eating from Crete? James, I don't think is from. I think he's like second generation. Talked to a guy the other day, Savas, who's first. Is it first generation when you move here from Greeks? I can't remember, but anyway. Man, I tell you, if Europe wasn't as insane as it is, I could handle living on Crete. Can you imagine living on Crete in Greece? Oh, my goodness. But Europe is so freaking nuts, man. I can't live in these guys can all kiss my butt. It's nuts that the U.S. is still the freest place in the world, other than maybe Sweden. It's nuts that Georgia is still, other than Florida and South Dakota, is where I'm at right now, other than stupid Fulton County, is the freest place in the world. Tell me that's not insane. I'm living in the freest place in the world, and I freaking hate it because I know I got to wear the stupid mask. Well, I don't have to, but everyone looks at you. Well, where was that the other day? I forgot. But it's just like, it's Chloe's lacrosse game. It's outside. The weather's nice. No one has coronavirus. They still got to take your stupid temperature. You still got to wear a mask. So of course, I pulled mine down because people piss me off with their stupid mask. And a lot of other people were too. I was like, thank the good Lord. Here in Georgia, so what I do is I wear a rifle. I have my main gun association, which is 2 AK-47s. I wear that to keep people who are afraid of me at bay. I wear my 10th Mountain hat to make, with this camo, and I have my mask that says 556 on there, and I pull it down here. That way people are worried. Say, oh, that guy's a crazy right-winger. Stay away. He might do insurrection at the Capitol. I'm like, yeah, you can stay away if you're worried about the freaking corona, because you don't shut down and quarantine healthy people. Crazy talk. All right. Anyway, huge fan of VTI. Right on. Yep. So James, I'm just joking on you when I'm talking about that you can't get underwriting. I was just giving you a hard time. 5.45 times 3.9 guy. The hell's 5.45? I don't even know what that is. Is that 5.56 or 7.62? Is there a new cal or what? What's a 5.45? Never heard that. That's nuts, man. 5.45. How old am I? Damn, I'm getting old. I talked to a guy the other day who's not even big on firearms. I'm not even that big on firearms. I just like them. He bought his first AR just because he said, I better because I want to. I don't want people to tell me what I can and cannot do. I said, yeah. AK-74? That's the Soviet answer to 223? Really? Wow. Interesting. Came out in 1974. Wow. I did not know they had I know they had AKs or an answer to 7.62. I did not know they had their answer to 223. Look at what I learned from old people here. And Kim, get out of here. I said you better have an excuse to miss the show. That's not an excuse. Freaking out. Banned. All right. I can't say anything about pulverizers, but right here. We are all a huge fan of VTI here. Lots of bold heads on both Reddit and bold site itself, though. Are saying we should be doing VT now? Yeah, okay. Yeah, the Boglehead people kind of get on my nerves. All right. I might do another live stream tonight. I like live streams. I got a lot of stuff I want to talk about. Lots of stuff. I want to talk about my man. I want to share with you this guy, a couple articles that I want to go over, which is this one right here, Why Annuities Suck by my man, Chris Barfield. So I want to share that. I want to go into, hold on, stop that. I want to share another share screen. Hold on a second. Right here, I want to share this from the Heritage Foundation. What taxpayers, workers, and retirees need to know about the union pension bailout that has nothing to do with COVID. Yep. Kitces had an article today, Michael Kitces from kitces.com, about the bailout. What financial advisors need to know. I want to share that. And I got something else on here I want to share too. I'm drawing a blank. But anyway, so, all right. We'll see you guys. Appreciate y'all being here. And come on over and like Amar's videos when Josh signs off. Right on, man. Yeah, I was thinking about doing it at 9 o'clock tonight, Kim. I got to see what the old ball and chain needs me to do, but I don't think she does. So I was thinking about doing it at 9. I like live streams. They're fun. All right. See you guys. So I'll put a thing out there later on. Appreciate it. Increase the peace in the Middle East. Well, they can't now because Sniffy Joe's in. Trump was increasing the peace in the Middle East. Now it's just going to be endless wars, forced vaccinations, and what else? And lockdowns. It's a great time to be alive. All right. We'll see you.